Everyone wants to know what to buy before a market crash, but almost no one asks the more important question: what should you be getting out of right now? Because if history has proven anything, it's this. The biggest financial losses don't come from missing opportunities, they come from holding onto the wrong assets for too long. Before every major downturn, there's a phase where everything still looks fine on the surface. Prices are stable, headlines are mixed, and most people assume things will recover like they always do. But underneath that surface, something very different is happening. The smartest investors aren't just preparing quietly, they're exiting quietly. Before the 2008 financial crisis, institutional investors were already reducing exposure to over-leveraged housing assets months before the collapse became obvious. During the dot-com bubble, insiders were offloading tech stocks while retail investors were still buying the hype at peak valuations. Even in 2021, before the tech correction hit, many large funds began rotating out of high-growth, high-risk names while retail enthusiasm was still at its highest. And the pattern is always the same. By the time the average investor realizes something is wrong, the exit liquidity has already disappeared. This is where psychology becomes dangerous. Because humans don't sell when they should, they sell when they're forced to. We hold on to assets because of hope, bias, and past performance. We convince ourselves that it'll come back, that this time is different, or that everyone else is still in. But markets don't reward belief, they reward positioning. And right now, if you track capital flows, insider activity, and sector rotation, there are clear signs that certain assets are quietly being reduced, avoided, or completely exited by smart money. Not loudly, not publicly, but consistently. So while part one was about where capital is moving into, this is about where it's moving away from.
Because when pressure builds silently, without a clear breaking point, it doesn't trigger immediate reaction. It stretches people instead. It normalizes strain. It teaches them to adapt to conditions that would have felt unacceptable just a decade ago. Think about how quickly expectations have shifted. A grocery bill that would have shocked you a few years ago now barely gets a reaction. A rent increase that once felt outrageous is now something people reluctantly accept and adjust around. A lifestyle that used to include saving, planning, and some level of financial breathing room has quietly transformed into one where the goal is simply to make it through the month without falling behind. And the most important detail in all of this is that the shift didn't happen through one dramatic change. It happened through hundreds of small ones, layered over time, each just manageable enough to tolerate. That's how systems don't break, they erode. And when they erode slowly, people don't resist them. They adapt to them. But adaptation has a cost. Because every time a household adjusts, cuts back on food quality, delays medical care, leans slightly more on credit, postpones saving, they're not solving the problem, they're absorbing it, they're carrying pressure that used to be distributed across a functioning system. And over time, that pressure accumulates in ways that are hard to see from the outside but impossible to ignore from the inside. So the real question isn't whether people are struggling. That part is already clear. The real question is why the system still looks stable while the people inside it feel increasingly unstable. Why consumption hasn't collapsed, even when financial comfort has. Why the numbers suggest resilience while everyday experience suggests something very different. Because if you can understand that gap between what the system shows and what people actually feel, you start to see what's really holding everything together right now. And more importantly, how fragile that stability actually is. The easiest place to see where this pressure becomes real isn't in a financial report or a government data set, it's in a grocery store. Not because food is the biggest expense people have, but because it's the one expense they interact with the most. It's immediate, it's frequent. And unlike rent or insurance, it forces a decision every single week. That's what makes it so revealing. Because when something fundamental begins to shift in a system, it doesn't show up first in the numbers. It shows up in behavior. And grocery stores today are full of behavioral signals that something deeper has changed. Start with something simple. The way people shop. There's a visible hesitation now, a pause in front of shelves that didn't exist before. People aren't just picking what they need. They're calculating, comparing, adjusting in real time. Items that used to go into carts automatically now get reconsidered, swapped, or quietly put back. That change alone tells you something important. It tells you that the margin, the small financial cushion people once had, is gone. Because when margin exists, decisions are fast. When it disappears, every choice becomes deliberate. And the numbers behind that hesitation are not imaginary. Over the past few years, food prices have risen significantly across multiple categories. In the US, for example, grocery prices saw one of their fastest increases in decades during the early 2020s, with staples like eggs, meat, and dairy experiencing sharp spikes at different points due to supply chain disruptions, feed costs, and inflation pressures. Eggs, which for years hovered around a relatively low and stable price range, surged multiple times due to avian flu outbreaks affecting supply. Beef prices climbed as production costs increased. Cooking oils, grains, and packaged foods followed similar upward trends. These aren't luxury items. These are foundational components of a basic diet. And when foundational costs rise, the impact doesn't stay contained. It spreads across the entire household budget. But here's what makes food different from every other expense category. It's flexible. You can't negotiate your rent every week. You can't decide to skip your insurance payment without consequences. But food, you can adjust. You can buy less. You can switch brands. You can stretch ingredients across more meals. You can delay a purchase. And because of that flexibility, food becomes the pressure valve of the entire financial system at the household level. When costs rise elsewhere and there's no room left to absorb them, the adjustment shows up here first. Not because people want to cut back, but because they have no other option. And the data reflects exactly how those adjustments are playing out. Across income groups, not just lower-income households, there's been a noticeable increase in store brand purchases replacing name brands. Bulk buying has grown, not as a sign of abundance, but as a strategy to reduce per-unit cost in a high-price environment. More importantly, there's been a quiet shift in what people are actually buying. Fresh produce, higher quality proteins, and perishable items are often the first to be reduced, not all at once, but gradually. One less item this week, another the next, until the overall basket changes shape. What replaces them tends to be more shelf-stable, calorie-dense, cost-efficient options. It's not about preference, it's about survival within a fixed budget. The reason the system still looks stable, even when households feel increasingly unstable, comes down to one mechanism that rarely gets discussed in plain terms: debt. Not the dramatic kind that shows up in headlines, but the quiet, normalized, everyday kind that has embedded itself into how people live. Because here's the reality: the gap between what life costs and what people earn hasn't disappeared. It hasn't been solved, it's being financed. And that distinction changes everything. At a surface level, nothing looks broken. People are still shopping. Bills are still getting paid. Transactions are still happening at a scale that suggests a functioning economy. But if you look just one layer deeper, the structure starts to look very different. In the United States, total credit card debt has crossed the $1 trillion mark, a record level. At the same time, average interest rates on those balances have moved above 20%, making it one of the most expensive forms of borrowing widely used in everyday life. And yet, usage hasn't slowed, it's increased. That alone tells you something critical. People aren't relying on credit because it's convenient. They're relying on it because it's necessary to maintain continuity. But credit cards are only part of the picture. Over the last decade, a new layer has been added: buy now, pay later services. What started as a niche option for online shopping has quietly expanded into everyday spending categories: clothing, electronics, even groceries in some cases. The psychological appeal is obvious. Split a payment into smaller, manageable pieces without immediate strain. But structurally, it does something more important. It allows consumption to continue even when cash flow doesn't fully support it. It smooths over the gap, making financial pressure less visible in the moment while extending it into the future. Auto loans tell a similar story. The average cost of vehicles has risen significantly, and instead of reducing demand, the SIST.
But when interest rates rise or liquidity tightens, that same leverage becomes pressure. Costs increase, margins shrink, and positions that once looked strong can become vulnerable very quickly. That's why smart money tends to reduce leverage exposure early in uncertain cycles. Not because leverage is inherently bad, but because timing matters. And holding leveraged positions when conditions turn is one of the fastest ways to magnify losses. And if you step back again, the pattern continues to repeat itself, just from a different angle. High growth without profits, overheated real estate, discretionary spending, long-duration bonds, hype-driven plays, and leveraged positions all share one thing in common. They depend heavily on favorable conditions. When everything is working, they perform. But when the environment shifts, they're among the first to feel it. Smart money doesn't wait for that shift to fully arrive. It reads the early signals, adjusts exposure, and quietly steps away while the majority is still comfortable. Because just like buying early creates advantage, exiting early preserves it. Up by this point, the pattern should feel clear, not dramatic, not chaotic, just consistent. Smart money doesn't panic at the peak of a crisis. It adjusts long before the crisis becomes obvious. While most people are focused on what's going up, a quieter group is paying attention to what's becoming fragile. And that difference, that shift in focus, is where the real advantage comes from. Because think about how cycles actually play out. At the top, everything still feels normal. Growth stories are still convincing. Real estate still feels like a safe bet. Spending hasn't fully slowed, and markets haven't given any obvious signal to exit. That's exactly why exits happen quietly. Not because investors have perfect foresight, but because they understand risk doesn't announce itself. It builds slowly underneath confidence.